Hi, my name's Darren O'Malley from Stanley and Williamson. Today I just want to run through some of the key issues from the federal budget that was handed down last night that are likely to impact on our client base. The main measures that are proposed will be in the superannuation area, as well as some tax benefits for small businesses. So firstly, with superannuation, the concessional contribution caps. So concessional contributions are those that you get a tax deduction for. Either an employer claims a tax deduction for it, or you make personal contributions for which you claim a deduction. Prior to 1st of July 2017, you can claim a deduction for contributions made of up to $30,000 for anyone under 50. Or up to $35,000 for people above 50. That cap is being reduced to $25,000 effective from 1st of July 2017, and that's irrespective of your age. Something that offsets that reduction a little bit is you're now able to, or from 1st of July 2017, anyone who doesn't maximise their concessional contributions is able to carry forward the shortfall in their contributions for a number of years, and that's on a rolling basis over 5 years. So if you don't maximise your contributions, if you don't make $25,000 of contributions every year, then you can make a larger lump sum deductible contribution in a year that suits you. The ability to do that is limited to those individuals that have got less than $500,000 in their super fund. One barrier to super contributions for older people, those over 65 and under 74, is that you need to satisfy a work test at the moment to be able to make a contribution. That requirement's going to be removed from 1st of July 2017. So if you're 65 or approaching it in 2017, then that's a bit of good news. You can continue to contribute to superannuation even if you're no longer working. Rules have been eased a little bit for personal super contributions. So current rules only allow you to make super contributions that are deductible if less than 10% of your assessable income basically comes from employment. So logic is that if you're employed, your employer's providing super guarantee support, so you're not entitled to personal deductible contributions. That rule changes from 1st of July, so the 10% rule disappears. So from 1st of July 2017, you'll have the ability to make deductible super contributions yourself, even though you are an employee. Also from 1st of July 2017, the income threshold for Division 293 tax has been reduced. So Division 293 tax is the extra 15% tax that's imposed on super contributions when your total income currently is above $300,000. From 1st of July 2017, that threshold's reduced to $250,000. One of the bigger changes, and the one that applies from last night, is that there's now a lifetime cap on how much you can contribute as non-concessional contributions. So non-concessional contributions are those amounts that you want to put into superannuation, or you do put into superannuation, but you're not claiming a tax benefit for them. So yesterday, you had an ability to contribute up to $180,000 per year. And you could, or most people could, bring forward a couple of years. So you could do 3 lots of $180,000 in 1 year. So a total of $540,000 under the bring forward rule. Those limits are gone, and now you've got a lifetime cap of $500,000. So non-concessional contributions, you can only make $500,000 of them during your lifetime. That cap takes into account any non-concessional contributions you've made since 1st of July 2007. The reason for that is that that's when the ATO have reliable records of what went in as non-concessional contributions. So if you're already above 500,000, you can't make any further non-concessional contributions. Any contributions that you made that might put you in excess of that $500,000 that you made prior to last night won't result in any excess. You can leave that there. But if you mistakenly put money in from here on in, and that takes you above 500,000, you'll need to take it out or you'll be penalised. So that's talking about super that is accumulating in your super fund. On the other end of the transaction is when you start to draw your pensions out. So prior to 1st of July 2017, you could have all of your super in pension mode if you had satisfied a condition of release. That had big advantages, especially if you're over 60, because firstly, the money that any assets that are supporting a pension are tax-free to the super fund, and any pension that you're drawing out of the super fund, if you're over 60, is tax-free to you. There's a new restriction that will commence from 1st of July 2017, where your pension, the amount that supports your pension, will be restricted to $1.6 million. Any excess will need to just be in accumulation mode. So it'll be invested in your super fund growing, and any income that it earns will be subject to 15% tax instead of nil that it would have been while you're in pension mode. If you've got pensions exceeding $1.6 million at the moment, you need to reduce that balance by 1st of July 2017. A final thing on pensions is that the tax exemption up until 1st of July 2017, any assets that are supporting pensions, whether they be full pensions or transition to retirement pensions, the income was tax exempt. That tax exemption for transition to retirement income streams stops from 1st of July 2017. So transition to retirement pension is a pension that you're allowed to start prior to retiring. So typically you'd start it as soon as you reach preservation age. You used to get a good tax benefit from that in the super fund. That'll be gone from 1st of July 2017. Small business changes. A lot of our clients are small businesses, and there've been a few positive changes there. So from 1st of July 2016, the threshold where you're considered a small business has been increased from $2 million up to $10 million. So that'll bring a lot more businesses into the, provide the ability for a lot more businesses to access the $20,000 instant asset write-off that's available for the next 12 months or so. It'll allow them to use the small business pool, and importantly, it will allow them access to the company tax, small business rate reduction. So we'll talk about that on the next slide. Importantly, this increase in the turnover threshold does not apply to small business CGT concessions. So if you're trying to access small business CGT concessions relying on the turnover test, you're still restricted to the $2 million test. In conjunction with that, from 1st of July 2016, the tax rate for companies that are small businesses, so with turnover of less than $10 million, reduces to 27.5%. For any company that had a turnover of less than $2 million, its current tax rate would be 28.5%, whereas for a company that had a turnover of between $2 million and $10 million, its company tax rate would currently be 30%. So from 1st of July 2016, the less than $2 million companies get a rate reduction of 1% on tax. And for companies between $2 million and $10 million turnover, get a bit larger tax reduction, that's 2.5%. There's some longer range reductions also planned to be phased in. So the turnover test is proposed to increase over a number of years, and the rate reduction also reduces over a number of years. So by 2026, It's projected that all companies will only be paying 25% tax, but that's so far off that it doesn't really have a lot of interest to our clients. Those small business clients that are not incorporated, so they might operate in their own name or through a trust or partnership, don't get to access the 27.5% corporate tax rate. Instead, they get a discount on their tax bill. The discount is at a fixed rate of 8%, increasing to 16%, but the benefit of that's limited to $1,000, so it's a minor benefit. So some of these changes are positive, some are negative. An important thing this year is that we have an election coming up on the 2nd of July. So none of these measures are going to be introduced until the Parliament sits again after the election. And at this stage, we don't know who is going to be in government. That means the opposition's response to the budget will be important. It's delivered tomorrow night, so it'll be worth paying attention to that, as well as paying attention to the polls. We've outlined measures that are proposed. That doesn't mean that they're going to become law. They do give us a guide for planning going forward. So at this time of year, we're spending a lot of time, our team is spending a lot of time on doing some tax planning and business projections and restructuring for our clients. So this information gives us a bit of a guide to help you to maximise your position. It's more important than ever to plan your super strategy, and it's a good time to look at restructuring as well as your usual year-end tax planning measures. So please contact us if you'd like some specific individual advice on your circumstances. Otherwise, thank you. I hope this has been of help to you.